Good morning, good afternoon, good evening. This is a new episode of PairTrade Finder Pro, and in this occasion we are doing something different based on the backtest that I did recently, where I was trying to compare in 12 different scenarios how do different standard deviation and RSI combinations would vary profitability. In this video, when I say standard deviation of 2.7, 3.0 or 3.5, I'm referring to the empty stretch setup in the software for that specific parameters. And please consider likewise that the exit has been set up at 1.0 standard deviation. The objective was to not only find the best scenario with my database, but also answer some questions like the one that appears here. Is RSI filtering really something that could add alpha to the strategy? Is the default setup that we normally use in Fast 50 good enough? I'm gonna also let you know how to do it yourself, but there is some pre-work that I would recommend, which are the two videos below. The first one is how to find profitable pairs. And the second one is the one that appears in here, which explains why RSI is something we should consider in pair trading. Okay, but before we proceed to do that, let me once again reiterate the disclaimer. I would like to ask you to read this couple of minutes, because it is important that you understand that this is just only for education purposes, and it is completely subject to the disclaimer that appears here. Now, with that, the working hypothesis that we use for the backtest is 27 months worth of data. It is based on my working database of 250 pairs. Many of them are Fast 50 pairs, but there are some others of my own research. Leg size that I use is 5,000. And then what I do is study standard deviation scenarios of 2.7, 3, and 3.5. And each of those combined with an RSI of 3070, 2080, and 1090 scenarios. As I'm using a leg size of 5,000 per leg, I need in my account to have a margin of 2,500 to hold a position, provided that we're using a 4-to-1 leverage. This is the setup and the parameters in each group to make the backtest, just in case that you ask yourself. So with that, first scenario is the one that combines a standard deviation of 2.7 and different RSIs. The way to understand this slide is the following. It's a little bit populated, but bear with me because it's very easy to understand. First thing that you see here in this square is the scenario being described in this square. For example, this is standard deviation 2.7 with an RSI of 30 and 70. So what I extract from the software is the gross amount of profitability being done in the period, the most negative run within all the trades, the maximum, and the average, but also an important one, which is the number of trades. I also get the gross profitability, negative profitability in this case for negative trades and also positive trades. With that data, I extract the win rate, average risk reward, profit factor, average days in trade, and the important parameters that we are going to compare, which is the size of the account needed in order to hold this number of trades, or the total net profit after margin, commissions and slippage, which is this figure here, and the total return on the period of the 27th month compounded, and also the average return per month. So let me show you quickly how I do it. You can go to the trading signals menu, specify from which date you want to consider your study, and from this point here you just simply export it to Excel, and you can manipulate that file in order to extract the same data as I did. So I have here the 4 different options with a standard deviation of 2.7, and then I begin varying the RSI. I go with a 3070 RSI, 2080 in this square here, and 1090 in this square here. And then you can begin comparing the different results. Let's see in this table here, same what we have just depicted, but in a way that is easier for your eye to be recognized which are the best scenarios. What we have here is standard deviation 2.7 and the 4 filters, but now you can compare each and every one easily. I have highlighted here the one that I think that in my case, with my database, is probably the best one, balancing all the different parameters. We go to the next one where standard deviation is 3. I have highlighted here the RSI of 3070 because I get a very good number of trades, a very good net profit after margin. The account size has not increased that much compared to the previous one, and the average return per month is 4.43, one of the highest. So a very interesting scenario, and this is the one that I would apply if I would go with this standard deviation. And finally, the most extreme set of parameters, standard deviation 3.5. I have highlighted here 2 scenarios. The first one is the one that I rather prefer because it has a very accessible account size, 30,000, with a 4.91 average return per month, but still maintaining more than 250 number of trades, which is maybe 2 or 3 trades per week. Now, the analysis would be incomplete without a proper risk management add-on. So I have added a final column to measure the equity risk if some trades in a row would go wrong. The pairs have been screened for a maximum drawdown of 15%, and literature says that we should consider at least the maximum drawdown estimated multiplied by 2 for testing purposes, which in our case is applied to a 5,000 per leg, which translates to 1,500 maximum loss. So last column in this table measures the estimated loss per trade as a percentage of the account equity size, in order that you evaluate that there are some scenarios that in terms of risk management doesn't make sense. And those one has been highlighted in red. Most experienced traders will ensure that risk per trade is less than 2% or even 1% of account equity. And some others, highly risk aggressive traders with smaller accounts, sometimes could trade up to 4 or 5%. But that of course increases your risk of ruin if you're experiencing a string of loss. It is therefore a trade-off between risk and reward And the most important thing for a trader is that they have an accurate measure for the real risk and understand the true trade-offs they are taking with their position sizing strategy. And with that, the only thing on my side is to wish you a very good trading.